Live. Hello, fellas. It's March 24, monster rally today after selling off every day, like waterfall sell-offs day after day after day. No idea where anything is today, but I know that I don't know where the market is. Do you know where the market is?
We are approximately in the middle of a face-ripping rally, up 7.4% on the S&P. Congrats to the people that bottom-ticked American Airlines, up 33% today. Wow. Strong day trade for you. Much respect.
Penny stock.
So we got some big ones out there.
High yield index continues its meteoric ascent. It was at 10.8 something today. It's a vertical line. I've never seen anything like it before. It's going to blow through 2,000, which took like 2 years to get there.
Don't be a Debbie Downer on an up day.
The Fed's coming in. Well, they're going to buy it all.
The only saving grace is it's yesterday's data. Like I don't have it live. I've got the close. Do you want to do the intro, Bill? Let's find out what we're all talking about.
Yeah, sure. Welcome to the face-ripping rally edition of Value After Hours. We don't get to say it very much, so we might as well today. Jake, what are you going to be speaking about today?
I'm going to be talking about Maubousin's newest white paper that's talking about biases, information, and noise.
The bin.
Been there, done that, it's called.
And Toby, what are you going to be talking about?
So I did some buying and selling on Friday. I just want to talk about I'm astonished at some of the things that I have had the opportunity to buy. I think it's kind of interesting and how the portfolio is positioned for the coming quarter.
And I'll be talking about some of the blow-ups in the hedge fund hotels that I saw. Specifically, the Liberty Complex has been destroyed. So we'll be speaking about that right now.
Right after this. I kind of like that intro. I miss that intro. I got to work out how to cut that in here somehow.
Tell you what, man, that outro music is hot too. I find myself dancing to it sometimes.
How We Do It by Grace Mesa. I think it's on YouTube.
Strong song.
Yeah. She kind of gives me that old-fashioned special feeling.
Well, that's for you and her to discuss. This is a
family-friendly podcast.
Sort of family-friendly. Although, trigger warning, again, we do curse on this thing, especially when the markets are down. Today we'll be happy.
The other thing is, you should throw some comments in. I'm reading the comments. It's just I'm going to concentrate a little bit more on the conversation this time because I was totally distracted last time. But definitely love the comments. And if we see anything, I'll throw it up and we can chew on it. And if you want to put a question in too, that's where it should go. You want to kick it off, Jake? With Mauboussin?
Yeah, since mine's probably the most academic.
Let's eat the veggies up the front.
Yeah, let's eat our veggies up front. Now, this paper, if you're making any kind of decisions discretionary in an investment context, this paper I would call must read. And really, the gist of it is that, we all suffer from biases, and everyone.
Speak for yourself, mate.
Yeah, well, that's true. Most of us have read about them, but it turns out that almost does nothing. Just knowing about them does nothing to protect against them. You actually have to bake it into your process, how to control for it. So what's really fascinating is that the study that Mauboussin is largely quoting from is that they have this. They break it down into biases, information, and noise. And what would you guess was the most important factor of those three things?
Information to noise? I don't know.
So I
would think you want to reduce noise and bias, right? But that's not that's just. I don't think I'm adding anything to this conversation. I'm going to go back to the corner now.
Let's define what that. Can you define what they are? Let's talk about what they are.
Sure. Bias would be defined as when you use rules of thumb or mental shortcuts that can lead you astray.
The heuristics.
Heuristics, yep. So they did this study where and actually Mauboussin has done this one himself, where he's had 10,000 subjects take this test, where it turned out that on average, we had a 70% confidence on our guesses, but we were right 60% of the time. So in his data set, we're 10% or, we're 10 clicks over confident, which is probably what you would expect at a minimum. Information is a subset of signals that are used relative to the full amount of information that's available to make the decision. So you think about if you have unique information, if you update your views faster than other people, and then the weighting of components of information can make a difference. So like basically like, how the quality of your information and how do you interact with it. And then noise is actually chance variability in judgments. So the funny study that they cite for this is Money Magazine did this thing where they interviewed 50 accountants and they gave them the financials of a theoretical family of 4 that made like $120,000 a year. And they said, what's this family's tax bill? And they came up with the range varied from $10,000 to $21,000. Right. So the range then tells you what the noise is. And it basically like sort of a standard deviation of those things based on the same inputs tells you how much noise there is. Okay. So I'll cut to the punchline, but it turns out that 25% of the errors can be explained by bias, 25% by information difference, and 50% is actually from noise. So noise cancellation, noise, being mindful of noise turns out to be hugely important.
Well, how do you avoid it? Get the Bose headphones on.
Great question.
Those new AirPods,
that was
dude.
weak.
The AirPod Pros. Come on.
Three ways to combine, or 3 ways to reduce noise according to Mauboussin. Number 1, combine judgments. So that means independent and the errors offsetting. This is basically like wisdom of the crowds. That's one way to reduce noise. Use algorithms. So set rules beforehand that you think checklists fall under this category. And then number 3, they call it mediating
into the matrix.
assessment.
Then you just got to say number 2 again.
The checklist matrix.
They don't want you to know. It's something that they don't want you to tell us.
This is the really good stuff.
All right. Number 2, use algorithms, which means setting rules and then following checklists. Number 3 is what they call mediating assessment protocols. And what you think about that is like you basically define what attributes you think are the most important for making the decision. And then you gather facts and then you assign some kind of a score to them. It's almost kind of like an algorithm, but like run through a human processing. So those are the ways that Mauboussin talked about reducing noise.
Yeah,
I feel like one of the thoughts that I had when you were talking is rather than trying to be so precise in like what you think fair value is for something, widening your fair value estimate a lot. I know it's like really unsatisfactory for people to hear that, you think something is worth, I don't know, say $7 to $14 billion, right? And like that is not precise at all. But what it does say is I think if it's less than 7 materially, it's a good buy. And if it's north of 14 materially, it's probably a sell. And anywhere in there, like, I think embracing some of the imprecision is a smart takeaway.
You're not gonna sell any newsletters with that attitude.
Yeah, I know. I can't pound the table on but I'm not in that business, which is helpful.
I mean, you can. I think that's a pretty good explanation of it, though, isn't it? Like if you find it trading at 3 and 7 to 14, like that's a good deal. It's just when it's trading at 10 and your range is 7 to 14, it's not very helpful.
Yeah, then you sort of stay away or
it's
hold,
a pass,
right?
But most positions are that way anyway, right? Most things are just it's 7 to 10. I mean, it's 7 to 14 and it's trading at 10. Like that describes 90% of the positions that stocks that are out there at any given time. Maybe not now.
Maybe.
Yeah, now it's been a little nuts.
I really love that approach, and I try to, I build that into my process. I have very strict screening, very strict update with outside information, build portfolios in a particular way. I 100% agree with that and adhere to it as strictly as I possibly can, because I think that I'm guilty of all of those bias and so on. I'm too competitive about it. It makes me too gets the juices flowing too much. So I gotta wind it back and get a little bit cooler when I'm doing the trading and putting positions on.
Yeah, Bill, how about you? What's the I think you're maybe the little more discretionary, a little more qualitative.
I certainly am now. I mean, I tell you, my brain reacted like a week ago or so by trying to go to what I perceive like quality at a discount and a lot more diversified than I normally run. And then at the bottom of the portfolio, like I'm not, this is not investment advice. I don't know how many different ways to say it, but like I picked up Sabre. I think and it's tiny. It's really tiny, but I think it's a debt special situation. Their credit agreement indicates to me that the lending group understands that these type of events happen and that they might be willing to amend. Given my background, I think it's possible that they amend. And if they do, I think it's a 3 to 4x.
What is it, Bill? Can you just give us a little bit more background on it?
Yeah, it's like they're basically like the back end, what certain people see when they're booking seats and stuff like that. I mean, basically it's a bet on hotels and airlines coming back at some point, right? And it's just, I think right now it's a debt bet more than anything. I think it's an amendment issue. I don't even think business quality. I don't know that it's a business I'm trying to own for the really long term, but I view it as a debt special situation.
Is it travel in the streets and sass in the sheets?
It's definitely not SaaS. They like to say they're SaaS. It's like super cyclical. If bookings aren't happening, it's not getting revenues to the extent that right. So it's not like a true recurring business. But anyway,
given the true,
so I don't know.
Diversified here. Can we just let's just quantify that a little bit, because Pabrai, who famously was very concentrated going into the last big drawdown, and then he said that was a mistake and he became a little bit more diversified, or he said that he became, I don't know practically what that means, but then a few years ago I noted that he went back to being concentrated again. So what's your definition of how are you weighting positions? Like, what's a special situation trade size for you in the portfolio?
That's like nothing. It's 0.5%, because one, I don't know the business as well as I need to, and two, like I really do think it's a debt workout situation, and I think it could be a zero. So, I'm not
0.5% though. Like by typical finance standards, is actually not that small of a bet.
Yeah, but I don't believe in typical finance standards.
I'm just trying to add a little context there.
Yeah, I mean, I'm 21 positions right now.
But doesn't that implies?
And that's probably
200 positions, doesn't it?
Yeah, that one's tiny. I mean, the top of the portfolio, the top 10 is still like 60%. So, but I have a lot at the bottom that normally I wouldn't have necessarily. Now you can say, well, why not just pile into the top 10? I don't think that you have the most certain of times right now. So I'm trying to pick things that I think give some counterweight to what's going on at the top and can make it. I mean, I'm more concerned with making it through this period than I am getting super greedy.
One of the things that I've been struggling with a little bit lately is the last couple of years, I feel like I've been forced into and down into some more marginal businesses. Just because that was kind of the only thing that even got a little bit cheap. Like no good businesses were really on sale, in my opinion.
Yeah.
So I kind of got anchored into a lot of like studying these businesses that were sort of marginal businesses to begin with. And now it's like, oh, they're cheap and I know them. So should I add more to those? Or as it turns out, like there's this great chance to maybe potentially upgrade your portfolio quite a bit in business quality now. And so struggling a little bit with the sunk cost fallacy of like, well, you already know this one and it's a lot cheaper than before. So stay with the horse that got you here. But maybe here isn't where you wanted to be. But it's a weird kind of like intellectual exercise to try to force yourself out of the things that you kind of feel like you know.
Well, it's not only that, you got the consistency bias too, that you want to be even if it's only to yourself and to your clients, you got this idea that if you change your mind quarter to quarter, does that mean that the thing that you did a quarter ago was a mistake, and therefore you're kind of admitting to a mistake? Whereas it's hard.
What if it rips right after you sell it?
Right.
And you're like, oh. It's hard.
I agree with that 100%. That's the thing that I've been talking about without sort of naming names too much. I know I've been talking about Berkshire. Clearly, I've bought some Berkshire. I didn't think I'd ever get the chance at Berkshire, and I kind of used to poke fun at guys who were, it's Barbarian Capital's line where he calls the 13Fs from, there's a whole lot of value guys who all huddle together and who buy all exactly the same stuff, and he calls it generic value partners when you combine their 13Fs. And generic value partners is always Berkshire, number one, probably Markel, Fairfax. That's just standard. No matter what's happening, that's in the portfolio. And then whatever the hot thing of the day is. So for a while it was Valiant, until Valiant took everybody to the woodshed. And more recently it's been, I guess it's like Microsoft and a few other things like that. I don't want to call down the thunder from the compounder guys, but there's am I doing it already?
No, well, I mean, I don't know, but look at what TransDigm did. That was crazy. That was one of the ones that I think is almost certainly hedge fund liquidation, because it went from 600 to 250 in no time. And I get that they have leverage, and I understand that people think they're predatory and stuff. I think that was a massive unwind. And it's sort of interesting to watch these Momo names now that they're not Momo and see who's going to hold through all this stuff. I think you get to find out who's a real compounder versus who is sort of a momentum trader. Sorry if you can hear the children. That's my life right now.
I got some in the background too, but but that hasn't been shown to be a problem yet, has it? So one of the interesting things that I saw yesterday, it's a Bloomberg article about the fact that the Nasdaq 100 is it's outperforming the S&P 500 kind of by the widest margin. I don't want to say ever, but ever since the 2000s. And I haven't done this analysis myself, and I really don't want to do it myself. I'm hoping that someone already knows where it is out there, but some way of comparing the composition of the Nasdaq 100 to the S&P 500, because I've had a variety of guys. There's basically two streams of thought in my Twitter feed when I raise that. One of them is this is just a blow off top in tech, and we're going to see that reverse at some point. This is Nasdaq versus S&P 500. The other view is, well, these are superior businesses. They generate more free cash flow. They've got better balance sheets. They've got higher returns on invested capital. It's entirely appropriate that they are extending the lead through this period of weakness. Also because many of these businesses, they're not really that affected by the shut-in. Everybody's still using Google. Everybody's still using Microsoft. It's not like an airline or energy. I don't know what the answer is. I'm interested to know, though. I'd like to see the data. If anybody knows of any research comparing the composition of those two, I'd love to see it.
I think it's probably both, to be honest. I mean, right now, I think people are fleeing to quality, right? So the cash flow quality is huge in something like Microsoft. I do think that the growth is going to slow, and they can't withstand a lot of businesses closing without having their numbers reflect some of that, right? I mean, they're not immune. But I also think that if you're an RIA and your clients call you and they say, what do you own? And you say, oh, well, we got you Microsoft through this period. That's a whole lot easier than saying oh, we're taking a risk on, Dollar Tree or whatever that, and even if it's not the right move, I think people are selling stuff that, I think a lot of people are going to make good money picking some of these bombed out names and winning. I think right now a lot of institutional incentives are not to have that phone call come at how close are we to quarter end? How many people want to record
very close
or report that we own a bunch of we own a bunch of junk. But here's your
TransDigm.
I bought those airlines after they blew up. Midway through the blow up.
Yeah.
Well, I mean, anybody who is long a lot of those, I would recommend going and looking at what advertising looked like towards the in last time we had an economic contraction.
Yeah, it's like a 1.5 multiplier.
That's a line item that can change. So I would.
Yeah,
I'm not as sanguine about ad revenue coming in the door.
The other side of that
problem.
The other side, though, is Facebook just rumored to make a multi-billion-dollar Indian acquisition if they're allowed to. They have an insane balance sheet. Even if advertising takes a hit for 2 or 3 years, the business is still in a much better position than like a hotel.
What about those two articles yesterday? I think it was yesterday about, I think one was Wall Street Journal, the other one might have been New York Times. Evidently they were independent. Somehow they both came out at the same time, where they've, in the discovery for one of the, it's related to the advertising. Somebody, not a very big entity, is suing them. Possibly it's a precursor to a class action. And they've got this discovery, and they've got a whole lot of emails where they were copying Sheryl Sandberg and so on, saying, look, it's kind of where it's telling people that they're going to get these numbers, and they're just, the population doesn't exist in this geographic area. We're telling them the wrong numbers. Do you think that is going to hurt them? I mean, isn't that basically the core of what they do?
Tina, baby, where else are you going to go?
I mean, it's cheap. Maybe that's why it's cheap.
Yeah, I don't know. I mean, I find that to be one of the harder ones to get my head around, because I always struggle with the duration of the asset, and the other side of it is I do think that there is just a ton of latent earnings power in Instagram, and WhatsApp is pretty much enterprise software in the third world and developing generally. So I really don't know. That one's a hard one for me, but I bet they end up okay even if they're lying about stats.
Aren't they kind of hard to root for a little bit for you?
They are, yeah.
Yeah.
I kind of think the bigger risk for them is just what seems to,
I don't know.
It seems to me that there's now this sort of trend where you have the social network, whatever is the most popular social network of the day, kind of disappears because older people don't use it as much. The youngsters are the ones who are really social, and so they don't want to be on the same network as their olds are, and that's why you get this movement from MySpace to Facebook, and then to Instagram. But Facebook buys Instagram, and now it's TikTok, or it was like Snapchat for a while, and now it's TikTok. There's a point where you're just too old to keep on moving on to these new things, and there's I got to move on to another thing and discover everybody again, just so I can share photos of my kids, like.
Yeah,
I think that's what drives. And I hardly ever log into Facebook. I think I got a business type account in there, but I hate it. I feel sick every time I open it up.
The flip side is they say that their whole system's melting down because so many people are on it. So I don't know.
Fair enough. And I said the same thing to Marcelo Lima, who knows it really well, and he was like, "Well, just none of that is reflected in the numbers. Like the numbers are just staggering. They're really good and growing." So that's a better counter argument.
A lot of cash coming in the door.
Also, yeah.
And I guess, to the point that, look, if it's C-level people writing emails saying like, oh, this is fraudulent representation, that seems to be a problem. But I'm not sure, like Nielsen, are those numbers any better than what Facebook gives you?
It's hard to imagine, right?
So it seems like you got kind of a shitty comp as it is. So I don't know.
Well, let's do the next topic because we're about a third of the way through. Do you want to jump on it, Bill?
Yeah, I had hinted at it already with TransDime, but it was just like, I think Wednesday I was watching sort of the tickers that are hedge fund hotels. So, I mean, like Formula One, Liberty Sirius XM, that discount blew out. Just like a bunch of stuff that, TransDime was a compounder until people got scared and then they bailed on it. And I think that it's a combination of probably redemptions and maybe a little bit of leverage and a little bit of put selling all coming together at the same time to just, some of the drawdowns in those names. And like LSXMA has always traded at a discount to what theoretically it should have. But the discount recently has like really blown out. So that's when I had said, like, I think that there's a lot of evidence of pain going on. The energy MLP space I follow because of Kyler Hassan, and then I got involved in Energy FinTwit, and that's like hilarious.
Energy FinTwit is hilarious. It's worth going and having a look. Definitely don't make any comments because you'll just be
Wear
roasted.
gloves.
You're gonna get killed. And you deserve it, right? Those guys are like the OGs of energy. But like Mrs. Skilling had
a great account.
A tweet with 4 closed-end funds that basically just looked like liquidation phases. And if you look at the MLPs when they on that day, like they all just got slaughtered. So it was interesting to watch a lot of the tape. And I guess one interesting takeaway is I was listening to old Buffett stuff yesterday, and he was talking about the S&P puts that he sold, and because he understands structuring, he sold European options, and the American options you can put them at any time, and that stuff feels good in a bull market, but it can hurt when all correlations go to 1.
What are the standard ones traded on the? The ones that are traded on the not over the counter. The ones that are traded they expire on a date, right? So that's the American style.
Yeah, but you can put them at any time, right? So you got to be you always have to worry about rolling them and whether or not somebody is going to exercise on you. So like on Thinkorswim, for instance, the account that I use, it's all American style. So I can't sell a put and wait until expiration. I have to worry every day that somebody is going to put it to me, which is why I always buy a put under the put I sell. Try to manage my risk. Although my recent history on Tesla has just suggested to me that I should just avoid the game completely.
I rolled out of Tesla. The computer says no, so I was out of that one. The funny thing is, for this quarter, even though it was like a complete shit show and face-ripping rally, it actually ended up making money through the end of the quarter. It's one of the weirdest things I've ever seen. But definitely not worth it for the risk-reward was all wrong there. When you talk about hedge fund hotels, because Zero Hedge, rest in peace, tip one out for Zero Hedge. Now you can't even click on a link on Twitter to get through to Zero Hedge without getting a warning. They used to have this. They used to publish this pretty regularly, where they said, "Here are the concentrated hedge fund holdings," and they were all likely to underperform. How are you determining that something is a hedge fund hotel? Are you doing that quantitatively? You just kind of know that there's a whole lot of dudes in one.
No, I think I just watch. I mean, Charter's a hedge fund hotel, and you do the 13Fs, and you can see where they're bunched. But I do think a lot of the times those businesses they are hedge fund hotels for a reason. I mean, these aren't a bunch of dumb guys making a choice that, or some stupid decision to pump something. At least I don't think so in Charter's case. It's something I know about. But you got to be willing to live through some serious vol when stuff happens, because there are situations when they're all just liquidating. And you got to be able to take that drawdown and know what you own, to not take your response from the price action. You've got to be able to be like, no, this is fine. It's just what's going to happen in this name.
Think about it like from if this was a private business and those were your other business partners. It's an interesting way to imagine, like, oh, okay, that's who I'm in business with right now.
Yeah. I mean, I'd be okay with it if they're hot money and they just get scared at. I'd be like, all right, I'll buy your shares and whatever.
Well, that maybe is the right answer.
There used to be some pretty good research that those kind of concentrated holdings underperformed, and it was one of the things that I always wanted to look out for, because so on the short side, that's also the case where shorts are smart, right? So there's this kind of meme, I see it on Twitter all the time, meme, that's my accent. There's this thing on Twitter all the time where people are like, oh, there's a whole lot of short interest in this thing, so if you buy it, you're going to get this explosive move to the upside. That's not right. Shorts are smart. Shorts are in stuff, and they typically go down. Lots of research out there on that. Wrote about a few of the papers in Quantitative Value. The thing you have to be careful of as a short is being in something that's too heavily shorted, because then you become subject to the whims of the other shorts in it, and the borrow gets very expensive, becomes hard to make money. But it's a pretty good signal for a long, as is concentration, hedge fund concentration. Hedge funds just sort of, everybody, they must all know each other, go and talk to each other on Twitter or whatever, go get concentrated into the same thing without doing their own research. It's not a great signal for the most part.
Yeah, well, I mean, like Charter, when I got into it was when they had that integration issue, and people sold that thing like crazy. I don't have any data to support this, but I think when there are hiccups in those names, people just liquidate them. abnormally more than maybe some other things, but maybe I'm wrong.
Do we know of any blow-ups yet? Does anybody listening at home know of any blow-ups? There's been I've heard of a few, but they were kind of like stuff I'd never heard of before.
Company. Yeah. No name.
There have to be.
There was one I heard that blew up, but it was one of those ones where everybody kind of trades their own book. There's no single person calling the shots, and anything that makes me super nervous whenever I hear something like that. You just got some guy out there selling naked puts into the market, and hey, we blew up the whole fund. Sorry about that.
Well, Modest Proposal, when MVR was trading like crazy, I mean, he put out something that I think was English, but also might have been gibberish, but it turns out that it was English. It was some pod shop had blown up. I mean, he wrote a sentence that I didn't understand anything but he was completely right. He was like, something in the market is messed up. Somebody is
liquidating,
blowing out right now, and it was. Well,
to what do you attribute the big run up today?
Probably short covering.
It's also rebalancing. It's end of month and the stimmy.
We need the stimmy.
There's been stimmy all the way through this though.
Yeah, there's a lot of stimmy on the come.
When do we get our $1,000 or $2,000? When does that come through?
Well, you're phased out.
So you got to pay it back. Apparently, is that the right? I don't know. It's hard to keep up on all this stuff. It's almost not even worth it.
I want to know where I go for my bailout.
Some of the stimmy you got to pay back for sure, but 3 years.
Zero interest rate stimmy, zero interest rate line. I'd take it. I'd take a swing at Berkshire.
Yeah, I want that. I want to get in the Fed window.
Get $100 million and punt it on Berkshire leaps. If you can't pay it back, so what?
Not my problem now. Yeah. Well, you just described a hedge fund.
Yeah, that's exactly right. I just described a big bank, honestly.
Yeah.
That's that. Much. They should be able to. You can't have both. You can't have proprietary trading and be able to access all of that free money, because otherwise it doesn't take long, either consciously or unconsciously, for them to put together the idea that you can just go and shoot as much as you possibly want into the market, and if you heads I win, tails you lose. That's a great trade.
Shouldn't really surprise anybody at this point, right?
So we just got monetized. There was a super chat. I don't even know what that is. Thanks, Jason. Appreciate it.
Sweet.
What?
He just paid us for YouTube's non-monetization because I'm about to say coronavirus. There's our $6 gone.
There it goes.
Feed the family, man. You can't say coronavirus out here.
How's everybody going at home? Tell us how you're doing. If anybody's going nuts or anybody's finding something interesting, we're interested in it.
Do you see the picture of the baking soda on the floor of my house the other day?
I saw one of your boys' rooms.
Dude, these little fuckers took baking soda and poured it all over the house. All over.
Oh,
I walked outside. My wood floors were white. That's not easy to clean up.
No. Just add vinegar. I told you. It'll just boil off.
That's also a cure for coronavirus.
Yeah.
I love them, but they're testing me right now.
You know, we were joking about starting the podcast off with or saying bad words, and I was going to make the observation that in our household there's probably been more swearing in the last 2 weeks than the 2 years before that. Everyone's just kind of a little bit on edge. Like, it doesn't take much to tip over to where daddy's, dropping things he wouldn't normally say.
Yeah, still 4 to 5 weeks, so we'll see how we're all doing at the end of it. Might have a battle royale.
My little fellow, my 2-year-old, likes to walk around saying F and nay, and so we've persuaded him that it's what he should actually be saying is peanut butter. So now he tells everybody they're peanut butter. It's pretty funny. This is devolving. Let's move on to another finance-related topic. I guess it's
Toby,
mine.
You're up.
Oh, peanut butter.
Peanut butter and your peanut butter. That's how he uses it. So I've done a rebalance in the portfolio. Like I said, I'm absolutely astonished at some of the stuff I got to pick up. Picked up Berkshire, picked up Markel, picked up Schwab. They just all light up every single metric in this deep green color, which makes me feel really good because that doesn't often happen. Often there's a little trade-off to get them really cheap. So cover your ears, daddy's stocks are down. So I rolled out of I rolled out of E-Trade because it's caught a bid. I rolled out of HPQ, that's Hewlett Packard. That's the printer division, the really sexy part of the business, because that caught a bid too. And Icahn's in there trying to force something to happen. So I'm happy with the price that I got, so I'm rolling out of that one too. And then the short side of the book, there's a whole lot of commercial REITs in there. That's not a macro bet at all. It's just that that's what happens when things get really gnarly underneath and the market hasn't quite recognized what's happened. So it always makes me nervous when the model starts leaning towards some sort of what looks like a macro bet, but I'm somewhat heartened by the fact that Icahn seems to agree in this instance, and he's also short commercial REITs and commercial mortgage insurance.
What metric is it basing that off of right now? Like, how would it know that things are under, like, it feels like it's happened so fast. How is that incorporated?
What it likes is it hunts for negative free cash flow, really heavily indebted balance sheets, lots of share issuance, and so it's those things are getting picked up.
That's why I like Tesla. Okay.
Yeah, well, and also then it also, like, because that's not enough. Like, if you put that in, you're still picking up stuff that's going up 30% a year. So the thing that it also looks for is this broken momentum, which is, that's a little bit foreign for a value guy to use. But I know a lot of quantity guys, and I've tested it so much. I'm just sort of, it's real. Like the momentum factor is more robust than the value factor. That's kind of more of a recent thing, I think, but it's definitely a real thing, and it works long and short, like value does too. It's been the better side of my book through the whole time that I've been live, because it's it's kind of like the longs are just letting the team down all the time. The longs have been really terrible, but the short book's been pretty successful so far. I'm very happy with it, particularly because it just provides some protection there too. But even on a day like today, like, those shorts are lagging the long book on a day like today.
The broken momentum makes some sense to me, because I do think that when you follow the discussion that happens around certain names, when they're going up, they're these great compounders, and then the price breaks down and people are like, oh, that business is never that great. And it's like, well, you guys just talked
Narrative
about it.
follows
like,
price.
Yeah,
that's right.
It's ex-girlfriends, right? It's like, she wasn't that hot.
That's right. So I think that makes sense. People start to look at the price and then be like, maybe it's not what I thought it was, and then
sometimes
everybody
it's just
bails.
the business cycle too. Like, some things look like they're compounders just because they haven't seen a full cycle yet, and when you don't know what they look like through the downside of the cycle.
This one's going to be interesting because I don't think I ever contemplated the economy stopping for 3 months. And upon listening to our previous podcasts again, I realized that maybe I should have been listening to the conversation that we were having closer to while we were having it.
The one that we had on 25 February.
Yeah.
You sounded like you were listening to me. You were responding.
I mean, I was, man, but I guess... even when I was saying, like, are we really going to do this? Living right now, I still don't know if you rewound me 3 weeks, what I would have assigned the probabilities to this actually happening being. I think this is a unique case of humans coming together to try to spare a lot of other humans from a virus. I don't know that I would have bet that we would have done this.
I got to say, at this point, I'm really, really struggling to get a bead on what is happening, because it seems to me the stream is filled with two types of stories. One is that this is completely overblown. Everybody's already got it. They're asymptomatic. It's just like it's like a regular flu. If you're already old and infirm, it really isn't great for you. But for everybody else, it's just like this is what you get. You get some sort of cold once a year. Then on the other side of the stream is just these absolute horror stories of things that are happening to people when they get it. The numbers are exploding. I honestly don't know. And when I don't know, I want to err on the side of caution. So I would rather that we stay at like this for a little bit longer and just let's let everybody who's already got it get it and get over it and not transmit it to everybody else. And then when we reopen, whatever, like a week or so, and then see where we are at that point. But I still think the numbers are looking pretty scary. It's just hard to get good data.
That's why I like the Ackmans Plan.
What's Ackmans Plan?
I mean, it's not like he's not unique in it. It's just what I think is the right take. You shut everything down for like a month. Maybe it's a month and a week. Maybe it's just under. I don't know. But in the meantime, like, we got to get the fucking tests. Like, get tests out so that we know where we are. Because right now it's just a bunch of people arguing over stuff that we don't have any clue about. You can't argue when you have no idea what the numerator is. And you can't argue fatality rates when you're only testing the worst cases. Like, nobody knows anything right now. And it drives me nuts that we don't have the tests. And then we also got to get the tests to figure out who's immune. And then we can go back to life. So, like, this month, hopefully people are doing what the hell they need to do to get us where we need to be in 30 days. Then I think we could go back to some semblance of socially distanced life, according to people like Bill Gates and others.
What's tough is I'm very optimistic for that. Like, we will band together and figure this out as a species and humanity, and even like capitalism and like people switching over to making things that we need and stepping up for each other. At the same time, I'm not very optimistic that our government response will be adequate or that as helpful. Or so it's like, all right, well, if everyone is depending on government to be the answer to this, then I'm very nervous. But if people aren't, then I'm like, okay, we've got a good shot.
Well, I mean, the one thing that I wanted to do that I couldn't, or I didn't have time to do today, is to go through like the sectors of the United States and figure out like try to quantify like what really is the impact here. My boy Carson, shout out to Carson's ribs.com if you need any takeout. Great. His dad like didn't even know what the internet was and bought ribs.com as a domain name and just like crushed it in delivery. But, you know, like he was really bumming. He's the guy that I was talking about, went from 170 tables to 70 in a week and then to like nothing. They've already sort of innovated. You know, they're delivering craft cocktails and barbecue sauce, like jars, which is, I mean, it's like very cool. And thankfully they were busy with delivery on Friday night. I hope that continues for them, but it doesn't help the waiters much. You know, It doesn't get tips to the bartender. It can try to keep the business alive, but it's tough going.
We're coming up on 15 minutes, so throw your questions in now, and we'll get to them. I just want to how do you guys feel about the market here? This is just speculation, just for fun. We're just talking about. Nobody's got any idea what's happening. I've seen a lot of bottom calling last week. There was a Brady bottom, there was an Ackman bottom, there was a Tepper bottom. I think the guy who was the least confident was Tepper. When I'm sure they were hoping for him to give a balls to the wall kind of comment. Instead, he was like, "Oh, which stocks? Yeah, I'm buying some stuff, but I'm buying stuff that I'm not just indiscriminately spraying money around."
Probably not what you're buying.
Yeah. And then, so they definitely didn't want to. And so Tepper, funnily enough, he's the guy who's called the bottom at the moment. But I see a lot of guys who are like, swing for the fences right at the very top. They're the ones calling a bottom every single day. Like I said, I thought it was rude to call tops, but evidently you can call bottoms like you got unlimited respawns in this game. So I don't understand the rules, honestly.
Well, I think that there are certainly interesting opportunities right now. I don't know what the overall market's going to do. I mean, that's too hard. But, you know, there's a just company... Twitter would call it a shitco for sure. Intrepid Potash. I mean, that company is so cheap. The equity versus the what they put into the business. Now, you know, a lot of their investments were to serve the oil patch. That's blown apart right now. People would say they've been horrible capital allocators. Not necessarily untrue, but like it is cheap. So I you know, that's not something that I'm going to buy in size, but I have looked at it very closely to include at the bottom half of the portfolio. And I don't know, like something like LSXMA. I mean, my boy Francisco Oliveira was telling me yesterday about it. And, you know, I mean, I think you're at like a 12.5% cash flow yield out of the gate. Today, maybe it's 10.5%. Like, that's a subscription business. Are people going to canceled their Sirius XM. So, I think there's bets out there to make, but the overall market's probably got lower to go.
What about you, JT? What are you doing?
I hate these kind of questions, but I will say that I'm keeping a lot of reserves for potentially better buying opportunities. I could be totally wrong, and we go right back into the pain zone for guys like us. Yeah. Which, would not surprise me at this point. Like there's been lots of points already where I thought things were going to devolve from where they were, and they didn't, and it came back even harder. So, I mean, why not? But I'm very, very curious. Like I kind of want to see Q1 numbers at least before I would ever want to push all chips in.
Here's a question. What are you going to learn from those Q1 numbers? Because you already know they're going to be funky, right?
Not funky. Totally fucked.
Well, there's half of the
you got a month of no revenue.
Yeah, I don't know. I just it could. I'm not sure the market necessarily is discounting how bad it could look.
Okay, well, you say that, but the other side of that is, and I don't know what Bridgewater's process is, but JP Morgan cited Bridgewater, and they said that the market right now is anticipating 10 years of lost earnings.
Oh, come on.
That's what they're saying.
It's not. That's just not. It's not statistically true.
Take it to JP Morgan. Don't take it to me.
This is one of the funny things I've been.
Does not check out there.
I spent a decade that included 08 saying this is what the Schiller Cape is, and I'd get these guys coming in all the time saying the Schiller Cape is wrong. It underestimates earnings here because it includes 08, and that was an outlier year. And I'd say that's the point of it, to take a 10-year inflation-adjusted average of it.
Yeah.
Now when I put comments about the Schiller Cape up, people come in and they say, yeah, but that includes 10 years of like super normal earnings. You just can't win. Like, that's the point of the thing. It's better than price to sales. It's better than a single year P. I'm just using it for context. It's not a trading tool. I'm just using it to explain where we are in the process. When I look at it,
where are we right now?
It's still expensive. I would be astonished if this is all done at this point. I feel okay saying this on a big up day because I'm not fear mongering on a big up day. I'm not trying to do anything.
Do you want to cry? You can cry if you want to cry.
Do I look like I'm about to cry?
No, I'm just saying. You can
I work
out if you want.
I'm just. Oh yeah, I see. On a big up day, mate. I'm Australian. I'm only allowed to shed a tear if a dog dies. On a big up day like this. On a big up day like this, I feel okay saying it. So here's what I think. I think it's still super expensive. I think we're still below all of the moving averages and all that stuff. We're about to go through a rebalance period. Funky stuff happens in rebalances. It goes up and it goes down, moves all over the shop. High yield spread is still exploding. The TED spread, which is the difference between US and LIBOR, blowing out. I haven't seen, there'll be a print out today. It was at 0.86 last week. Once it gets over 1, it gets really scary. So my thought is probably that there's a fair bit more to come here. And I'm saving my big bazooka shot for either June or September when we go through it. That's my 2 cents. So I'll be hung by that. You can all come back and roast me in a year's time when that all turns out to be wrong.
I'll tell you, if I was super bullish, I'd be looking at small and crappy, and my portfolio still skews pretty big.
Did you see the
because I think there's going to be more pain.
This morning, O'Shaughnessy came out with a little research paper that was talking about, maybe we'll talk about it on the next podcast, but just to tease it.
I haven't read it properly. I skimmed it.
It might be really cheap, man, but you got to pick the ones that survive. And like right now, you really want to pick small? I'll tell you who's not getting bank lines. I'll tell you who's not getting a lot of help. Like, if you want to be somewhere, you want to be big. But that's also why it's going to rip when it does.
Here's a few questions, because we're running out of time a little bit. But here's the first question. This has been thrown up a few times, so how are younger, non-value investing generations supposed to accumulate wealth at these low interest rates, expensive share prices, real estate bubbles, climate problems, etc.?
Buy Bitcoin next.
Nah, come on, you gotta give an answer.
Well, what do you mean by non-value investing? Like, it's like Munger says, all investing is value investing.
All intelligent investing.
Yeah.
He's saying if I'm buying an index, why won't these boomers let me have good prices? Is that the question, basically?
Yeah.
I mean, I would just say that when in history has owning assets ever really been a bad thing? And if you do it over your time and you use your paychecks, I mean, this is why Buffett says just dollar cost average over time.
The key
now,
is
maybe,
spend less than you earn. That's the key.
Yeah, and keep buying.
Stick it into assets. Just keep on doing that. You'll be so far ahead of everybody else, it won't be funny.
And the Fed will bail you out until it can't anymore, and then we'll have different conversations and nothing will matter.
It's too dark, man.
This is a more technical one, so this is a good one. If you have a disciplined holding period and a few stocks in the portfolio are at the end of it, do you act as you would regardless of this market drawdown, or do you delay taking action?
Smartest move I've seen has come from somebody who I think is a very intelligent investor, and he went to all cash before all this started. That's what he did. I wrote an article about airlines and how I was going to hold it through all this and sold it the following week when the information changed. I don't believe in rules right now. I think you have to look at the facts and figure out what you need to do to live with yourself. I mean, and you're bound to make a mistake. I'm not comfortable going to cash because I personally want to own equities over the long term, and I don't think I'm going to be good dancing in and out. But I have made moves that I never thought that I would make within the portfolio right after being pretty public about saying that I'd hold them.
Going to cash is almost always the wrong decision. Almost always the wrong decision.
His was right, and he was right for the right reason. So, but I agree with you.
So there's a little bit of research on this that I've seen where discretionary investors tend to hold positions a little bit longer than they should and suboptimally, and lose some of their alpha from it. So if you have designed sell rules, I would probably try to stick with them. I think they're there for a reason. Selling is obviously the hardest part of this game, but I would say follow your procedures that you created during times of calm, and don't try to get cute when it's panic time.
Endorse. Stephen, isn't Schiller Cape still expensive because Q1 numbers haven't come out? I just answered that question.
Well, don't get him started again.
No, if anything, that makes it even more expensive.
He meant cheap. He's corrected just a little bit lower down. But the point is that you're already taking a 10-year average of inflation-adjusted earnings. Like, there are going to be ups and downs through that period. That's the point of it, that it gives you this some
smoothing.
I do think something that you guys have talked about, and I think is almost certainly true at this point. I would like to think, I should say, that we're going to end up insourcing a lot of American manufacturing. I think margins could come in, right? I mean, the idea that EBIT margins are always going to be this. I could see there being some labor pressure on your SG&A if we insource stuff. That there's a lot of ways for earnings to come in. I think there's a reasonable chance that Biden's going to get elected. I could argue that corporate taxes are going to go up. There's some risk here.
What does that make you do?
I mean, nothing. But I just think
take all macro valuations that are earnings based with a grain of salt right now. Like we were going into this like 2x history's normal profit margins. That has been a very long mean reverting data set, and had been defying gravity for quite a while. So I don't know. I mean, at your own risk, you think that things will go forever that have historically been mean reverting.
A good question here from Martin Titus. Why is selling the hard part? Nobody knows, but everybody agrees that it is. I don't know. We all think about buying. We all spend 99% of the time thinking about buying, and then the first time you go to sell something, that's the first time you think about it.
I think it triggers a lot of our behavioral problems where disposition effect, where the things that you own, you assign a higher value to them than other people would. A lot of sunk cost on research, commitment consistency bias. It's a minefield of behavioral issues for selling, much more than buying, I think.
Yeah, good answer. I agree with all of that. You want to take a stab at it, discretionary man?
No, I don't.
Yeah.
It's been pretty beneficial for me. I was looking back
selling?
at performance. Yeah.
What's your sell cue? Just when it's overvalued, or what are you? Oh no, you're looking at more. Obviously, you're looking at more than that because
back pains. Is that the?
Yeah, probably back pains.
Your quote. I put your quote up on Twitter about the airlines. I thought that was interesting about the left tail manifesting, like underweighting it in your initial assessment and then bringing it in and then thinking about it, like seeing it manifest and changing your view on it. I thought that was a good.
I never even would have fathomed this.
Yeah.
I mean, somebody was like, "Oh, yeah, park half the planes and then have the rest of them be 20% full." I'd be like, "What the heck are you talking about? That's crazy." Yeah, I mean, that was a sell decision. That and Budweiser were almost the exact same, or AB InBev were almost the exact same sell decision, where I got privy to facts that I did not think were going to exist when I underwrote it, and I was like, "I'm not holding through this risk."
You're not saying that's not inside information. You're just saying you just read something.
Yeah. And I was on a JP Morgan call, and the guy was like, "This is going to decimate emerging markets. All of AB InBev's M markets are emerging. Like, I'm not trying to hold through that. It's just not with that kind of leverage." The bet had changed. So, how do you know when the bet changes? I don't know, but that time I knew.
There was a question here before about space. Sorry, I can't scroll back and find it. But anybody have a go at Virgin Galactic? I'll say this about Virgin Galactic. You don't want to short momentum on the way up because it makes you look like an idiot. And you don't want to short it on the way down because it makes you look cruel. So I wouldn't touch Virgin Galactic with a 10-foot pole. But, you live your life. I wouldn't go anywhere near it.
I made a joke on Twitter when it was like, probably pretty close to what it top ticked, but it was at something like 6 billion times sales.
Is that a lot?
Is that, I don't know about your valuation criteria, but
it's a very good company. That's a compound.
Just decrease your discount rate, man.
Yeah, true. Yeah, what's the growth rate that you need on that to grow into 6 billion times sales?
I just that business. It's just the market is so tiny. I just don't get it. I don't know, and maybe I'm the dolt. It's fine. I'll live without owning it.
The bet is, I guess, that, and I think this is possible in our lifetimes, that intercontinental, like long-haul flights become flights that go out into space and come back down. And so Sydney to London, which is like a 24-hour flight, and then you got to transit through Asia somewhere, becomes a 3-hour flight, which you can do on the weekend. Because I don't know how it works, but I'm not a physicist, but you get out of Earth's air and you kind of zip over and then you come back down. A weekend in London.
Yeah.
Sounds fun.
Sounds great.
Is there only going to be one competitor? I mean...
Well, total eventual supply, as you guys often point out.
Car industry is not a great industry. Airline industry turned out to be not so great for me. I'll let people handle space on their own.
Bill, question on NVR. Got any thoughts?
Not really. Nothing that anybody else doesn't have. I mean, people love its balance sheet. They love the guys that operate it. Culturally, it's supposed to be fantastic. But I don't have any unique insight.
So here's a good one. Mark B. Instead of picking single stocks in this current market environment, wouldn't it be safer and a lot easier to just buy the SPY?
Nah, dog. First of all, real quick, back to the MVR question. Buffett in 2009 laid out, I think, how he thinks about housing. That was a really good discussion. The 2009 morning session is worth listening to. No, I think picking individual stocks is the best thing to do right now. But that's what I do for a living, so I'm sort of not the right person to ask here.
Jake Taylor?
Long enough time horizon, no problem with that. I think you may experience pain along the way that it best be ignored and dollar cost averaged into. But I mean, I don't find, let's imagine the S&P 500 as a single company that I wanted to buy. I don't find the metrics of that company to be particularly compelling relative to the cost of it. So now if I disaggregate it, there's probably some things in there that maybe make more sense. And I think we're heading to a time period where there will be more dislocations for individual companies I think we're heading more to a stock picking time period. We have not been in one really, I don't think, for the last, 5 years at least.
Yeah, I agree with all of that. That's exactly what I think. What metrics do you look for when you're picking a bottom? No one can do it. It's impossible.
I just do it as much as possible and send out newsletters every day so that I can say that I picked the bottom. I'm just setting up the next 10 years of my life.
It'll only be obvious in retrospect. You'll only know like a year later, and you'll have missed it by that point.
I'll make sure that I cite the day that I sent out the right thing. That's how I hedge my bets.
I'm going to tweet it out every day and delete it at the end of the day.
Half down to your population, and then that next one you send the next market call half up and half down, and then eventually you're a hero to a small subset of your mailing list.
And I'll pay a lot of money for that. Unintended consequences of higher corporate taxes under Biden.
Many.
Yeah, I don't know. I'm just telling you what I think is probably coming, not the consequences.
Well, it should make things. They're just worth less.
Yeah. Yeah, but that's sort of an intended consequence, right?
But you got to think about that. I mean, if it's worth something at X tax rate, if you're doing a valuation, you got to put in a new tax rate that changes the value.
2016, basically, right? Everyone was willing to pay more for corporations because of lower tax rates.
Yeah, that's right.
So the opposite seems like it would hold.
I got two. One more from Martin. Does it say anything that Buffett has not come in and bought anything with all his cash?
Jake?
I don't think it does. For mine, I don't think it does. I assume he's just crazy busy doing stuff. Why would you tip your hand when you're in there doing your work? Like, I would just get it done and then let everybody know after the fact. I think some people are concerned that they've got some big insurance liability there, that they've underwritten something funky and it's going to put a hole in them. It's just not the way that they operate. They know the size of all the stuff they underwrite. They know roughly the likelihood that it's going to happen, and they get a big fat premium. This is for the Ajit Jain funky super cat stuff that they do. All of the other stuff is just sort of run of the mill. I don't think they're going to get dinged too hard.
I'll take the counter argument just for fun and say that it does tell us something in that I think it tells us a little bit about the quality of the opportunities that have so far been served up. Like it feels like, at least in my estimation of looking at a lot more financials, or not financials, but a lot more financial statements lately, that the good businesses are still not on just like knock your socks off sale at this point. It's been a lot of the other stuff was already kind of a little questionable to begin with. Yeah, and the stuff that Buffett wasn't really probably going to be that interested in anyway. That's my opinion. Like, I think it tells us a little bit more of kind of the bifurcation of the sell-off.
Yeah, I mean, the other thing is, I think people need to keep it in context. We are on March 24th, right? Like, February 28th, the world was still going well. And, like, all of a sudden, all these distressed calls are coming into Buffett, and there are these great businesses. Like, I just don't buy it. I think he can probably do a lot in the distressed market with high yield spreads blowing out like they are. I don't know.
Why shoot your wad now? Why not wait till you see the whites of their eyes, right? And
yeah, well,
because it's been a long time, maybe.
He might not be able to see the whites of their eyes.
He's been sitting for 5 years more on tons of cash. What's another couple weeks for him while the paint ratchets up?
Well, and I don't know. I mean, I don't know what the government's going to do with these big liquidity lines. I mean, they may take a lot of his opportunity right out from under him.
Yeah, that's my nightmare, is the Fed crowding out all the value investors.
Well, that's Chris Cole's thesis. He's said that before, that he thinks that the Fed kind of diving in every time it gets cheap means that it's been hard for value to get value.
Yeah, well, and all these people need liquidity, right? And they're basically saying, like, we are going to open the spigots of liquidity lines. Like, I just don't know how many opportunities there are for Buffett. I think everybody thinks there are, but I'm not sure there are.
Last question, just for fun. If you had to pick the single worst thing to invest in right now, what would you choose?
Boy, space is pretty hard to top.
I mean, my most hated thing is cruise lines because, like, screw them. They don't pay taxes here. And they'll probably rip if they get a bailout. But cruise lines and casinos, man, the casino stocks, if those things can make it, they are going to rip.
Congress? Is that a...
I want to see all the cruise lines and all the casinos get the bailouts. That's where the really important money should go. That's a joke, everybody who doesn't understand that. Anybody got any other bets for the worst thing to invest in?
I mean, I'd look small and a lot of operating leverage and a lot of financial leverage. That would be my combination to find the worst.
Yeah, and then get some sort of...
Although, yeah, then everything clears up and that's a 100-bagger on you.
That's right. Well, at some point, these things are going to rip. You just got to pick the one that makes it.
Shortfall. Look, folks, that's my pick. Shortfall. Shorting vol is almost always the wrong answer. Just that's how you get taken to the cleaners once every 7 years. That's Taleb's whole thesis. That's why he wrote the book.
Pennies in the steamroller.
That's time, folks. Thanks very much. It's been super fun as always. We're going to try and do this every week from here on in until I guess we get tired of it. Or you do, whichever happens first.
My money's on us.
Thanks, guys.
See ya.